some of the things I'm going to do is I'm going to break it down, go through it question by question, but I'm also going to like show you in the real illustration the numbers, right? And break it down for you as best I can for you to fully comprehend all this. But just be careful. Be careful not to understand the real core principles of becoming your own banker and the infinite banking concept itself and utilizing the same dollars twice and the way your cash flow um, is to be stored into a properly designed dividend paying whole life contract, right? Um, Not an index universal life, I'm talking about a cash value dividend paying whole life contract so that you can utilize it as a storage facility for your capital to be used for whatever else you want and really capitalize on the fact that you actually get use of the same dollars more than one time, right? So I'll break that down more, but I think that's something you may not fully grasp yet. Hopefully, after today, you at least are a little closer of understanding that. Okay, so let's take a look at this together, and we'll go from there. I'm going to share my screen and take a look. First of all, just as an example for you, I designed a policy just to kind of break this down right here, 60 years old, right, and health, pretty decent health. And I designed it to be a certain way. I wanted to maximize the efficiency of your flow of dollars. Okay. So the way I designed this was to minimize the death benefit. However, I designed it with a whole lot of what's known as paid up additions, which I'll explain in a minute. But I designed it this way so that you have extreme flexibility, liquidity, and control, right? So if you look at this, I designed it at where it says total minimum right here is 14,295 per year. But I designed it to show 50 grand a year going into the policy. And $100,000 as like a lump sum, which is known as the paid up edition, single premium paid up editions rider. Okay, so at its very core, you need to understand what that all means. But just to break it down a little bit here, 10 grand of it every year is going to the base policy. Okay. 4,000 of it is going to the term rider, which is only for 7 years. And then a lot of it is going to the paid up additions rider. I need you to fully grasp and understand that paid up additions, that's the rider. That's where a lot of the cash value, especially in the beginning years, come from. Okay, so if you notice, the minimum required doesn't really have much of that, right? 120 for the whole year. Okay, most of the dollars there are for the base coverage and the term rider, so that this policy does not become a MEC, a modified endowment contract. We wanted to minimize the cost of life insurance, but not too much because we don't want this to be a taxable transactions on you if you were to take the money's out, take loans against it, etc. Right? So 14,295 is the minimum. I designed it to show 50. You don't have to do 50 every year. Okay. It's extremely flexible, but that's what I'm showing. Okay. And when you look at this, just to kind of break it down, the first year, 100,000 lump sum plus the 50. Remember, most of those dollars, as you can see reflected here, that first year, 150 grand, 136,000 of it is cash value, right? That's the cash value itself. And the death benefit's 1.5 million that first year. Okay. So here's what's neat. When you fully understand what paid up additions are, the light bulb may go off. Okay. And I want you to think of it this way. Paid up additions is literally that. It is paying up additional death benefit. And when you're paying up additional death benefit, It's all contractually related, right? So paying up additional death benefit means the death benefit's going to immediately go up. Well, a lot of people don't fully grasp what the cash value really is. See, there's a contractual relationship between the cash value and the death benefit. If the death benefit's rising, then the access to additional cash has to rise with it. Because here's the reality. What cash value really is you as the policy owner having access to it. It's actually, if you choose to take a loan against it or even withdraw it, you're telling the insurance company, hey, I'd like to take that as an advance against my death benefit or against, the policy itself, right? Which is the death benefit covers it. So they're allowing you to take that knowing that if you were to pass away, the life insurance is there to pay it because it's an advance. It's an advance of a future death benefit that is going to happen. Like you know this, right? You're going to die. Okay? So they understand that, they know that, and so you're choosing to take a loan against it or even withdraw it if that's what you do, which you shouldn't. You should take a loan against it if you're practicing infinite banking. But you're choosing to take that. And that is actually an advance of the future death benefit that is going to happen, right? So that's why it's available to you. So if the death benefit's increasing, which is what paid up additions do, it is a system. It is directly correlated that the death benefit's rising, therefore the cash value has to rise. Okay? Because if you look at this design, if you maximize this all the way out and you live to age 121 years old, which is the most you can have on a life insurance policy, right? You notice it says $5.9 million death benefit here, age 121, 61 years later. But the cash value is exactly the same. It's designed that way on purpose. That is called efficiency. As the death benefit's rising, the cash value is rising. As the death benefit goes up, the cash value contractually has to go up. Pretty cool when you fully understand that. That's why when you fully understand it, you're going to flow as much money as you can into a policy like this because all it's doing is adding more paid up additions or adding more cash value, adding more death benefit, which is therefore is adding more cash value. And it's a system that just keeps getting better and better and better. Okay, so let's go ahead and look at the question. Okay, so the first, the availability of the funds. How soon after the policy and funding it are the funds available for borrowing? Almost immediately. Okay. Designed the way we design it, with most of the money going into what's called the paid up additions, not to the base policy, not to the term rider, right? I just broke that down for you. Okay. But when you design this correctly, like I would, much of the dollars are going towards the paid up additions. That means those dollars are actually available for cash immediately. And when I say immediately, it's going to take 10 to 15 days for it to process through the system, for them to make sure the funds clear, right? But it's all credited immediately, and it's available right away. The quickest I've done it myself, and actually I've seen a client do it, is about 10 days, where they gave the money, it got processed, it went through the system, they have their processing time, 10 to 15 days, but the quickest I've done it is 10 days. It was available. I took a loan against it immediately. Okay. So the next is reason for asking. Nelson's book says there's a capitalization period, and I assume that's because the example does not show a large day one cash outlay. 100% accurate. Now, the Nelson Nash, which is version 4, is even it's a little behind the times, I'll say, right? That's the fourth edition, Becoming Your Own Banker, fourth edition. The fifth edition is something that you should get, but it goes into a little more details of nowadays because the life insurance carriers, I put it in the email, but they've adapted, right? And they have more designs available to have lump sums like you're talking about, early cash uh, distribution into it, not distribution, but whatever you want to call it, deposit into it, into the paid up additions rider. So that you can design it, which extremely heavy paid up additions. And many infinite banking practitioners design the policies where it's, 70 to 90% of the money is available immediately. Some go as low as, 60. And, there's debates on which is better, long term versus short term. But many do 70 to 90% nowadays, right? And look at the policy design. That is how I just showed that to you, right? So the detractors have heard that you've heard say funds are not available for sometimes years. Again, not accurate, misleading. They're just feeding their narrative to you. Either, like I said in the email, either they're uneducated on what the truth is on how these policies can be designed. And look at me, I just don't believe that that's the case, that they're uneducated. What I do believe um, is that they have an agenda. They don't want to really accurately describe how you can design a policy to be, I mean, you can design a policy as high as 90% going to the paid up additions. Sometimes, depending on your age and life insurance and stuff, maybe not quite 90%. I typically will design it 70 to 80%, sometimes a little less, sometimes a little more, depending on what we're trying to accomplish with life insurance and death benefit and stuff like that. But man, I'll tell you what, some of these detractors, and I'm just going to be blunt, many times they're getting monies for referrals or advertising dollars coming their way, even business ownership in like short term or term life insurance policies. So of course they're going to push you towards that, right? Like think about it. And you know, I want you to understand that when people like Dave Ramsey, whole life insurance is a scam, never do it, it's overpriced, all that stuff that you hear, you know, it's just not a full representation of what the truth is. And I just want to be fair to that. When designing it for infinite banking purposes, for banking purposes, you can design a policy to be extremely cash efficient, as shown. Matter of fact, let me share my screen on that again to the life insurance stuff. Okay, so let's look at that again here. All right, I want you to see this. The first year, 150,000 is the total amount that you're contributing into the policy, right? If you just did it this way. And 136,000 is available after that first year. Look at year two. Like really look at this. $50,000 is what you'd be contributing. If you decide to do the whole 50, remember, you can do as low as 14,000. But when you fully understand this, you're going to want to do more. Matter of fact, the most you can do on this design, I think, is 52,000. That's the most. Minimum of 14, maximum of 52. Think about the flexibility of that. Minimum 14, to be exact, it's 14,295. The maximum, if you add 2,000, and the reason I say that, for those that are analytical, you notice how it says maximum allowed, this is for the paid up additions, is 37,000. Okay, that's what's added on top of the base and the term rider, right? I put 35 just to make it 50, but you can go up to 37 with that paid up additions rider. So really the maximum amount you can contribute in that year, in a year, is 52 grand. And the minimum is 14. You want to put 20? Fine. You want to put 30? Fine. You're going to probably, once this is all said and done and you fully grasp this, you're going to be flowing as much money as you can through this policy before using it to do other things with it. Okay. And so you're going to want to max it out every year, probably. That's your choice, of course, right? But when you see that and get that, it's a no-brainer. So what do I mean by that? Look at year two. Just look. I mean, get the detractors out of your head for a minute and look at the truth and look at the numbers. In year two, you put 50 grand in. After the dividends are paid, it grew by 48.8. Now, it could be 48.9, it could be 48.2, right? Because the dividends are a little different every year, right? Which we're talking about in questions. But look at this, like understand this. By year three, you put 50 grand in. It grew by 51 2. Year four, 50 grand is 53 9. 50 grand. Year five, 56 8. Like, look at the death benefit. It started at 1.5, 1.6, 1.67, 1.7, right? As more dollars are going into the paid up additions, it's causing an increase in the death benefit. If the death benefit's increasing, that's causing the access to the cash value. See, remember, that's an advance of your death benefit that you're allowed to take. And by year five, I mean, goodness, it's already at $350,000, right? 347 and change. Year seven, it's at 407. Year eight, 470. Like the cash value that you have access to is ridiculous and so efficient. This is not an investment vehicle. This is a savings vehicle, but way better. You're going to utilize these dollars and still get the compounding growth on the full amount, which I'm going to explain in a minute. Now, in year seven, right between year seven and year eight, you're going to notice that the death benefit goes down. Only for a few years as it starts growing up again. But that's because that term rider is only for 7 years. We absolutely can make it longer. The cost of the term rider will be longer. I just put that in the policy so that you have enough life insurance, enough death benefit, so that the policy does not become a modified endowment contract, a MEC. When you break this down and understand this, yeah, you're gonna love it. You may want a longer term policy and designed inside of it, a longer term rider, so that the death benefit's bigger for longer. But just know that as the paid up additions keep going in, the death benefit will continue to go up again, right? Because the term rider falls off here. Remember, 1.9 goes to 800. Why is that? Well, because the term rider, when you look at this, was for 1.2 million. So in year eight, that's not added to the policy any longer, right? And you notice in year eight, the 50,000 maximum is now, or not maximum, but the contribution is now 45. Why is that? Well, because you're not paying in the policy that term rider of $4,100 anymore. So now the minimum, it was 14,295, right? Not anymore. The minimum's now basically 10 grand, right? 9,999 plus 120, right? So 10,000 and change. So really the minimum after the seventh year is down to 10 grand. That's get now we're golden, right? Like that's even better. Okay. Again, once you understand this, man, you're not going to want to do anything else. Okay. Um, with dollars that you're going to even use for other things, including investing. So where was I? Year eight. It's at 835, death benefit, and the cash value is at 536. Then it's 913, 605. See, that will continue to grow, as will the death benefit. And it's brilliant. It's awesome. Okay. Detractors, we have heard say funds are not available for sometimes years. Just again, misleading, not right in any way. Okay. Um, and unfortunately, it's just the reality of the detractors. Again, probably not educated, or probably educated, but probably filling their narrative. There were whole life designs where most of the monies are going to the death benefit, and therefore not much money is going into the paid up additions rider, which therefore means, see, that's where the early cash value is really coming from. It's an access to those cash, the capital that's being built into the policy is through the paid up additions rider. Okay, now there's dividends and stuff like that that create more and more and more, but the detractors saying funds are not available for sometimes years is just not true of a dividend paying whole life insurance contract from a mutual company. All that's important, designed with the paid up additions rider in it and designed it a certain way with those riders involved. I will say Sometimes these detractors get index universal life confused with whole life. And many times with index universal life, the funds are not available for sometimes up to 15 years, you know, many are 5 to 10, but that's not what this is. Okay. So availability of funds after each cash infusion, how much are the funds available or how soon? Again, pretty much immediately. Just has to go through the process in as little as 10 days. Okay. All right. Number three, the availability of funds. Are there any other restrictions on borrowing the available cash portion that we don't know enough to ask? Reason for asking, detractors say that there are, but are woefully nonspecific. They're nonspecific because there is no. Anyone saying differently is wrong. Whatever is available in cash value as a loan against the policy, even if you have other loans you've already taken against the policy, it is like a line of credit. It is yours. You're the owner of the policy. You have the first rights to it over anybody, over the insurance company. It is you own the title. It is your policy, just like owning the title of a house or the deed of a house, right? You're the owner. You control it. Whatever is available in cash value as a loan against the policy, you have access to as a loan against it. It is yours. Whenever you want to take it, however much you want to take, up to the, whatever is available, right? So that is just a false statement. They don't ask why you need it. I want to take a loan against my policy. There's 100 grand available. I'd like to take 90,000, please. They say, great. You want to check or you want us to deposit into your bank account? Yeah, deposit it into my bank account. Great. Fill this out. Boom. Done. There's no application. It's a request. You can even do it right online through your online portal and have it in as little as 2 to 3 days from the time you do that. Okay. So it's just a false narrative once again. Okay. Question four, size of the life benefit. Can you explain the decision that go into choosing the coverage amount? What are the forces that might make a person choose a large death benefit? What are the forces that work in the opposite direction of a smaller death benefit? Explain how the death benefit changes or goes away. Reason for asking, just making a better decision. Okay. So for the purposes of designing this type of policy, for maximizing banking and maximizing those paid up additions riders, right? Remember, that's the magic sauce for liquidity, efficiency, control, flexibility. Okay. That is really where so much efficiency, especially in those early years, come into play. As you understand more, like please know this, that there's a whole idea of what is my lifetime economic value, right? Like how much over the lifetime of me, for the rest of my life, should I really be worth an accumulation? So if you can get your lifetime economic value in the form of a death benefit, where the cash value, like I showed you, actually matches that, like, or close to matches that, and you use all of it, great, right? Like, let's just, for argument's sake, you have this cash value that's building up. And because of that, the dividends even are causing more paid up additions, which is causing more death benefit. And so if that's constantly going up and your cash value is constantly going up, hypothetically, even if you used all of it and the death benefit now took care of it, wow, isn't that like be creative, use your imagination. If you had this ever flowing dollars going into this account that created more and more and more tax-free death benefit to your heirs, but yet you were still able to use those dollars for whatever you wanted, including investing, well, how much would you want to put into an account that you can have the best worlds of that? And the answer is as much as I possibly want, as much as possible, please. And if you're not there yet, don't worry, you will be. Okay. Um, really practicing this will only make your legacy larger, your death benefit larger, which therefore creates more capital because as your death benefit's increasing, the paid up additions create that death benefit, which means it creates more cash advance available to you, which is the cash value. Okay. You have to understand they're two separate buckets, but they actually work together. Really practicing this is going to make your legacy larger and larger every time you actually use it. And I even put the secret is the PUAs. When you fully understand what that means, everything else falls into place. Okay, and we could talk more about that if you want. Okay, there's a surrender fee. No, yes, technically, but uneducated, misleading, fear-mongering, just not accurate. I mean, there is a surrender fee built into the design of the policy. Okay. Matter of fact, what it really means, it's for every $1,000 of coverage is what it really means. This is whole life we're talking about. Okay. For every $1,000 of coverage, this is how much the cost of the life insurance is over time. Okay. And you can even see it in the illustration. Look, surrender cost index, right? By year 10, it's $50.75. Projected though, because of dividends, $24 for every $1,000 of it. They're manipulating you and thinking, oh my gosh, if I cancel the policy, I have to pay that. That is not what that means. Okay. Because I'm just going to give you an example. Let's say in year 10, because I just showed you year 10. Year 10. You now have $677,779 in cash value. That's all yours if you want it. They're not taking money from that. Okay. If you have a loan against the policy, well, then obviously, let's say you have a loan of 300 grand. Well, yes, 677 minus the loan, because like that's a loan against it. Okay. So you would get the difference, right? But there's no like the fees are built in to the overall design. Okay, it's not like when you go to close it down, there's a surrender fee that you have to pay, and it takes away from this 677, 779. Now, right here, the whole life design for infinite banking. They're not so many times these detractors are talking about indexed universal life policies. Okay. And when you understand what the difference is, which again, happy to talk about it, they're not whole life. They're not the same. Um, there is a cost of insurance built in, yes. But are they surrender fees? I mean, like, because it's already built into everything, it's clear as day. Um, it's not what you think, not the way that they're manipulating you to think. Many index universal life policies, now it can be a large surrender fee. Like you can say cash value is 100 grand, but the surrender fee is 10 grand, right? So that means you only have 90,000, not 100, right? That is very confusing to a lot of people, but whole life insurance contracts from mutual companies, dividend paying, right? All that matters. Participating, designed for infinite banking. As you can see, the cash value is it's going into the cash value that's created is actually more than the dollars going into the policy very, very quickly. I want to hit home on you on that again, okay? And why don't I show that really quick? Again, like look at year six, 50,000 in, yet that cash value account grew by 59,000 that year. So you could say you made $9,000 on that 50 grand that year, right? 50 grand in, 59,000 is what it turned into in the growth. So when you add up the cumulative, like, let's say 150 plus 50 is 200, 300, right? 350, 400, 450, 500, right? You're adding all these up, like there is more cash value than you put into the policy. Okay. And by year three, the new money going in, oh my goodness, look at that. 50,000 and it grew by 51. So from year three on, the new money going in is all profit. Yet you have a large death benefit and a bank to utilize. Hopefully that helps. All right. So let me close that down here. Is there a per transaction fee if you borrow the money? No, not true at all. Like Any detractor that says that it's not accurate. No transaction fee. All right. Interest charged. So when the cash is borrowed, what is the interest rate charged? Does it change? Like if it were tied to some sort of index. Again, you may be confused with index universal life connotation and discussions there. All right. Um, Interest is simple interest, and the rate change on an annual basis on the market. It's calculated every year. So on your anniversary date, they're like, okay, you had a 5% loan. This year it's, 4.5. This year it's 7%. Whatever it is, okay? It's very similar to the way a HELOC works in a way. And I think I'm going to put that in here. Um, these are mutual companies we're talking about, right? So understand, like, this is another like aha moment. We're all mutually sharing the dividends. It's the interest rate, first of all, is similar to a HELOC, nowhere near as volatile as what you see out there. It is one big system that all of us policy holders are collectively participating. I even put much like a credit union or a sharing healthcare sharing ministry, right? We're all coming together and sharing the burden, which is our premiums, right? Going in to these mutual companies, but we're also all sharing the benefit, which is the overpayment of premium because we're all mutual owners. So if we mutually own the company and we all gave more than it took to run the company, well, that's why it's returned to us. And that's actually one of the reasons it's not taxable because it's not actual growth. It's, oh, we paid too much this year. Well, for over 200 years in a row, that's how it's worked, right? Including the Great Depression, 2008, 2011, 2010, 2020, right? Recessions. The interest rate itself, it says it's similar to a HELOC and actually works in this. It's not an amortized loan, right? It is a line of credit. The way it's a simple interest loan, and so it's calculated once a year. And right now it's somewhere between 5 and 7% for most carriers. I do know of someone that's less than 5% still, right? Less, right, 4.65. But typically the ones that are less in the interest rate on the loans typically have a little less dividends too. So it's kind of all relative. It's all washing away, right? The highest interest rate that I know of right now is 7%. Most of them actually have a cap in the contract and in the illustration that the highest it can be is 8%. As a matter of fact, I could probably find that here in the illustration. It talks about that. There it is. Cool. Policy loans. Okay. The minimum loan rate is 0. Pretty cool to see that. The maximum loan rate interest rate is 8. Okay. So understand that like every year, it can be changed. And it's based on how the market is doing and how the company itself is doing, but it's nowhere near as volatile as the market is, not even close. It's an internal calculation that the company uses that they need to stay to be successful for all of us. Again, when you fully grasp that, that's awesome because the more you use it, the more it helps everything. We're all coming together as mutual policy holders and sharing the burden of it all, but also sharing the cost, the benefit of it all. Okay. So again, the max is 8%. Right now, it's around 5 to 7 for most companies, and we're good to go. Okay. So the interest itself, is the interest charged on borrowed funds simple or compound? It's simple. Now, if you choose not to pay it, well, then that's where these detractors say, oh, but look, it's compound interest. Because if you don't pay the interest on the loan, the insurance company has no other choice. Say, well, you haven't paid that, so we got to add it to the loan balance. Because look, what else are they going to do if you haven't paid the interest, right? It's simple interest calculated every year. If you don't pay it, well, now that loan has to be added to the loan amount. The interest due wasn't paid, so they added to the loan amount. So the next year, well, the new simple interest calculation, it's got to be on the total amount, right? You didn't pay it. So the detractor out there manipulates that narrative. It's a play on words and it's there to fit what they're trying to make you feel. Okay. It's simple interest. It's not compounding. Can simple turn into compounding because of you not paying the interest? And now the total amount is more? Of course, right? Pay the interest or pay back the loan or whatever. Okay. So our fees, are there other fees? No, there's no hidden fees or anything. It's actually extremely clear. The illustration for the whole life insurance is clear. It's actually, like I said, very regulated. Whole life insurance has been around forever. It's the core of the life insurance industry. Do your research, like understand how whole life works, and it's been the like tried and true. We just added in the industry more desires and more designs, the paid up editions, right? Things like that, so that it can become cash efficient, and such a unbelievable system when used right. So index universal life, IULs, are not as clear, and sometimes these detractors use it as a way to confuse and manipulate people's thought patterns about whole life as well. Okay, so the rate of return, the policy pays dividends on the unborrowed cash portion. This right here tells me big time that maybe if you're thinking that the policy pays dividends on the unborrowed cash portion, that is not accurate. This could be an extremely aha moment for you. You get paid the guarantee and the full dividends, guarantee plus dividends, on the full cash value accumulated amount, even what you borrowed against. It is two separate things. Think of them as two separate columns. Like this is the very essence of understanding infinite banking. And if you do, this could be the aha moment that I've been searching for you. All right. Column A is, all the cash value that's been building up. Column B is a loan against it from the general fund of the insurance company using your policy, the cash value, and ultimately the death benefit, because if you don't pay it back, we'll cover that. So you could even think of it as three separate columns. I said two, but you can say the first column is the full cash value accumulation that keeps growing, keep compounding, never stopping on the full amount. Let's say you have 100 grand in there. The loan against the policy is a different column. Think of it as an accounting practice. It's a loan against it. It's not a loan from it. So you're going to get charged interest from the general fund of the insurance company on the loan amount. You're going to get dividends and growth on all of it. Like even though let's say you got a loan for 50 grand against it, you're going to make the dividends and growth on the full 100 grand, even though you have a loan against it for 50 grand. And then you have the death benefit, which again, think of it as three columns. If you keep putting money into the paid up editions and keep paying those premiums and keep putting money through it, that death benefit keeps going up. Therefore, your cash value is going to keep growing too. And the dividends and stuff create more paid up editions. Understand that? The dividends create more paid up editions, which therefore creates more cash value. And that forever is going to keep growing and growing and growing. Not just on the unborrowed amount, even the amount borrowed, because it's a separate column, a loan against the policy as collateral from the general fund of the insurance company. Again, the very essence of infinite banking. And man, when you understand the full amount's working for you always, yet you can take a loan against it to do whatever you want with it, you want to flow as much money as you possibly can fathom into the policy and then use it for whatever you want, even investing. Okay? It shouldn't be an either or conversation. It should be an and. So, what is the guaranteed rate? The guaranteed rate does depend on the insurance company, but it's guaranteed and stated in the illustrations, in the contracts, depending on which carrier you go. I mean, I put this here. It's somewhere between 2.5, 3.5, some are three, some are 3.25, right? Typically, if their guarantee is lower, like just knowing the industry, their dividends are typically a little higher. Again, it's not about the product, it's about the process. We will use the best product we can for what you're trying to accomplish. I run them with multiple companies and we analyze it, right? But it's typically that. So, as far as the non-guaranteed rate, matter of fact, let me go ahead and make that black so that we can separate it. All right. Again, that depends on the dividends. It gets added up on top of the guarantee. It's so neat. I mean, I put this in here so you're going to read this, but it's based on the mutual insurance company's success and growth that year. It's happened, like, hear me on this, every single year with all these different mutual insurance carriers for the last 200 years. Some have been around longer than others, but like it just keeps getting better and better and more tried and true, and it works. Typically, the total growth, including the dividends. I mean, you add another 2 to 4%. We usually see somewhere, I'll go low and say 4.5 to 7% total. Every year is a little different, and that's total. I said 5 to 7, right? So I always say, let's estimate around five, but it could be a little more, it could be a little less. This should not be compared to investing. I put this in there because it's not that. This is not, well, should I put my money over here to invest, or should I put my money into a policy? This is where like the aha moment needs to come. You should still invest. You should still do the policy. It's a both and. It's not an either or. Matter of fact, you should, when you fully grasp this, use the same dollars to do both. Even investing dollars, the monies should flow through your policy first. Why? It created paid up additions, created a death benefit that was larger. Therefore, the access to that cash is more. And when you take a loan against it, the dollars are still compounding over here, even though you're going to use it to invest or buy something or do something with it. So why would you only want your money working once for you when you can have it working two, three times for you instead? So it has nothing to do, like you said, reason for asking, detractors say the rate is low. It doesn't matter. Like, this is not to replace your investing. This is to add to it. It's about where is your money starting to flow through before using it for something else, including your investment dollars. And see, Dave Ramsey and other detractors they can't grasp this, or they don't want to because it doesn't fit their narrative. Okay, so if you can understand it's about making a stop somewhere in an account instead of your checking account, instead of your savings account, your money's flowing here first, and then taking a loan against it to use it for other things, including investing. This is where you flow your dollars before doing anything else with it. Boom, 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 boom. Why? Because you get the growth on the full dollar amount, even if you take a loan against it to use it for other things. And boom, your death benefit just went up. Boom, because your death benefit went up because you did it with paid up additions, right? That's the magic sauce. Therefore, the dividends are more. Therefore, the cash value is more. Paid up additions create more dividends, creates more death benefit, creates more everything. And if the death benefit's going up, the cash value contractually has to go up. It's really amazing and incredible when you fully understand this. Okay. So hopefully that helps. The rate of return, the interest paid on the unborrowed cash is simple or compound. The interest paid on the unborrowed, okay, yeah, again, it's on the full amount. It's a whole formula. It also includes the death benefit. It includes contractually. There's a whole formula based on how the dividends are paid. But it equates to typically around 5 to 7% a year. Okay. But the larger the death benefit, also the larger the dividends too, because it's all a formula that the insurance company uses on how they declare your dividend size based on mutual ownership inside the company. Okay. All right. So death benefits pays the loan. If a loan is outstanding and never paid, and we die, the death benefit pays it. That's correct. Death benefits is the in this situation. I spelled situation wrong. Let me fix that. In this situation, pays the loan. And if doing it right, the death benefit is ever increasing as well, which I already explained. Okay. All right, dividends, paying the premium. Nelson Books has example where at some point the policy dividends are sufficient to pay the premium. That's correct. The minimum premiums, sometimes even the maximum premiums. How does this work? Just for clarity, that's a choice you have. Like you literally, you own the policy. You have access to do whatever you want. It is yours. If you fully understand uh, using the policy as a bank, and how the paid up additions just keep giving the policy more steroids and more turbocharge and more steroids, you would actually not exercise using the dividends to pay the premiums. But if you had to, you absolutely can. Maybe later in life, even though later in life is when like you put in $1,000 and it equals $2,000 in cash. Why would you not put the $1,000 in, right? But anytime you want to use the dividends to pay the premiums, you absolutely can. But the paid up additions is where the steroids and more turbocharging just happens. But you can. Okay. All right. So minimum slash maximum premium with a yearly. So long as you pay the minimum, all is okay. Compare this with the previous question of Nelson's example for the dividends. Yes, either way. You have more choices than that. You can pay the premium. You can pay the minimum premium. You can pay the maximum premium. You can pay anything in between. You can have the dividends pay the premium. You can even tell the company that you want the policy to be turned into what is called a reduced paid up policy, which therefore, what that really just means for you, it's pretty simple. No more premiums due at all for the rest of your life. If you understand what it means to utilize a policy as a banking source, you probably would never do that. But you can create what's called a reduced paid up policy, which means no more premiums due whatsoever. The death benefit is what it is. It will grow a little bit because of the dividends, but no more influx, which creates less growth. And you don't really want to do that, but you could if you needed to for some reason. Okay. Okay. So the tax freedom dividends are forever tax free because of they are not income and are instead a corporate return of premiums paid. Is that true? Okay. This is getting in the weeds, but yeah, true. Um, I'll say generally, dividends from a whole life insurance policy, especially mutual company, the way what we use is it's just not taxable. When designed correctly. Let me put that. Oh, I put that in there, right? Yeah, when designed correctly, like I do, make sure it doesn't become a mech. The dividends on a whole life policy, they're considered like a return of premium because we all mutually own the company. We're all mutually like a sharing ministry, right? Or a co-op, a credit union, we're mutually sharing the cost of that. So if we all pay too much, that's how it's contractually spelled out. It's not treated as income when it's a return of premiums, right? It didn't cost as much as thought as allocated for. So here's your excess back. That is a return on premiums. Also, when you take the loans against the policy, you're not taking it from the policy. That is a huge differentiator. So if you're taking the money as a loan against it, you're not taking it from it. It's a loan against the asset. The asset is the life insurance, right? That is the cash value. Okay. It is not income. So since not income, there's also no tax implication. Loans are not taxable at all. You owe it. It's a loan. against your asset. Just like taking a home equity loan. It's not income, right? It's a loan. Just like taking a car loan from a paid off car. That's not income. It is a loan against an asset. What do the wealthy do really, really well? They don't have much income, right? You know this. I know you know this. And if they don't have much income, they can't get taxed on income. So the more assets that you build, real estate, etc. Donald Trump does this, right? Takes loans against these assets. Kiyosaki talks about it too. Take loans against assets. By the way, Kiyosaki loves this strategy. Okay. But if you take loans against an asset, whether it's a home, a life insurance policy, a car, loans against something, even for whatever you're using it for, cannot be income. It's not an income. It's not something you earned. It's a loan against something. Okay, you owe it. Okay, so you know these detractors are just scaring you. That's all. Okay, so general question: does this make sense at our age? Yeah, it 100% makes sense. Again, I think maybe hopefully by the end of this, you really understand more. This should not be compared to investing. I don't care if you get 10%, 20%, whatever. Like, understand you can get 10% one year, 5% the next, negative 20 one year, 100% one year, which I know I'm exaggerating, but 30% one year, then negative 50%, then 20%, then 2%, then right? The average, okay, 10%. That's just an average. Like you've been at this long enough to understand what I mean by that. Like that's not real, okay? Average is not the same as actual. But that being said, like still do the investing. Just where are you starting your capital before using it for that investing? Like, use your imagination here. The more you understand, the more you're going to know exactly what the possibilities are and what you should do. But if you want to invest, still invest. I'm just going to say, where are you starting those dollars before you do that? Flow it through a policy. Why? You flow it through the policy, it creates a larger death benefit. Therefore, it creates access to capital. Therefore, it creates more. And it's a cycle of you're the bank, you're the wealth, and use that money to do whatever you want with it, including investing. It's like a no-brainer. So hopefully you get what I'm saying there. Happy to talk through that more. Hopefully this was helpful and not too long.